Suppose in a company, closing debtors are 45,000 rupees, net sales 3,60,000 rupees. Net sales means sales minus sales returns. Provision for doubtful debts rupees 5,000. Calculate debtors turnover ratio. So this is the question. Debtors turnover ratio is equal to credit sales upon average debtors. So far these credit sales are concerned. In the question they have given only net sales, and there is no way out to reach credit sales. In this situation, we will have to assume the net sales are the credit sales, means 3,60,000 upon average debtors. Average debtors means opening debtors plus closing debtors upon 2. But as per information, they have given only closing debtors. So we have no choice. We will have to take closing debtors as our average debtors. I mean to say 45,000. So debtors turnover ratio will be 3,60,000 upon 45,000. It means 8 times. So debtors turnover ratio in this question is 8 times if you are asked to calculate average collection period in days. So that will be 365 days upon 8. That is equal to approximately 46 days. It means in this company, goods are sold on credit and the money is recovered from the debtors after 46 days. Suppose in a question, debtors turnover ratio is equal to 5 times. Cash sales are 1/3 of net credit sales. Stock turnover ratio is 5 times. Opening stock 5,40,000 rupees. Closing stock 2,16,000 rupees. And gross profit is 25% on sales. It means if sales are 100, then gross profit will be 25 rupees. Opening debtors are 40% of closing debtors. What are the opening debtors and closing debtors? This is the question. So we have to reach opening debtors and closing debtors. Now think about the formula where opening debtors and closing debtors are used. There is only one formula where opening debtors and closing debtors are used, that is debtors turnover ratio. Means debtors turnover ratio is equal to credit sales upon average debtors, and average debtors is equal to opening debtors plus closing debtors upon 2. So this formula can be utilized to reach opening debtors and closing debtors. So debtors turnover ratio is equal to net credit sales upon average debtors, and net debtors turnover ratio is already given in the question, that is 5. So 5 is equal to credit sales upon average debtors. Or I can say 5 into average debtors is equal to credit sales. But the problem is we don't have credit sales, we don't have average debtors. So first of all, let me try to reach credit sales. And for credit sales, our stock turnover ratio formula can help us. The formula of stock turnover ratio, that is cost of goods sold upon average stock. And stock turnover ratio is 5 times. It means 5 is equal to cost of goods sold upon average stock. Opening stock and closing stock is given. That is 5,40,000 plus 2,16,000 upon 2. It means that is equal to cost of goods sold upon 3,78,000. It means cost of goods sold is equal to 5 into 3,78,000, that is 18,90,000 rupees. Now, one more information is given, that is cash sales is equal to 1/3 of credit sales. It means, the sales basically comprises of two things, cash sales and credit sales. And it is said that cash sales is 1/3 of credit sales. Suppose credit sales is 3 rupees. In that case, the cash sales will be 1 rupee. So total sales will be 4 rupees. So it means 1/4 is the cash sales of total sales and 3/4 is the credit sales of total sales. And you know the formula, cost of goods sold plus gross profit is equal to sales. So in that situation, we can say, suppose sales are 100. In that case, the gross profit will be 25 rupees. This thing is clearly given in the question. So 75 rupees is the cost of goods sold. It means 75 plus 25 is equal to 100. It means if the cost of goods sold is 75 rupees, then total sales is 100 rupees. But in our question, cost of goods sold is 18,90,000. So in that situation, the total sales will be 100 upon 75 into 18,90,000 rupees, means 25,20,000 rupees. So we have got the total sales, but now we are looking for credit sales. So as per equation, if total sales are 4 rupees, in that case, credit sales are 3 rupees. If total sales are 25,20,000 rupees, then credit sales will be 3 upon 4 into 25,20,000 rupees, means 18,90,000 rupees. Now we can calculate debtors turnover ratio because we have got each and every information for this solution. Debtors turnover ratio is equal to credit sale upon average debtors. And debtors turnover ratio is 5 is to 18,90,000 upon average debtors, or 5 into average debtors is equal to 18,90,000 rupees. Or I can say average debtors is 3,78,000 rupees. But our opening debtors are 40% of closing debtors. Suppose closing debtors are 100 rupees, so opening debtors will be 40 rupees. So in that situation, the average debtors will be 100 plus 40 upon 2, that is 70 rupees. It means if average debtors are 70 rupees, then closing debtors 100 rupees. If average debtors are 3,78,000 rupees, so closing debtors will be 100 upon 70 into 3,78,000, means 5,40,000 rupees. So we have got the closing debtors. Now opening debtors are 40% of closing debtors. It means 40% of 5,40,000, means 2,16,000. So in this way, we have got opening debtors and closing debtors, and the question is solved.